Hey guys, welcome back to the channel. Today we're gonna be talking about in you know we it just in we always talk about investment, but we need to talk about how being smart with your investments can reduce your tax bill, right? Pay less in taxes, have more money, be able to invest more money, right? We're gonna go over some strategies you can use that are gonna save you hundreds, possibly thousands of dollars, when it comes tax time, right? Um, as like a little example or whatever, let's take two people. They're both 30 years old, right? Jennifer and Mark, right? Single Americans, no kids, right? They both earn exactly about $60,000 a year, but let's say Mark pays $9,000, which would be 15% in federal income taxes, and Jen pays $5,000, about 8%, right? So what's the difference? Right? And no, Jennifer's not doing anything shady or anything like that. And no, Mark isn't making, terrible errors on his tax return, right? It's just that Jennifer's taking advantage of investing strategies that can legally reduce her taxes. And Mark's not. The results are, kind of catch you off guard, right? Because Jennifer gets to keep an additional $4,000 of her money that Mark doesn't. One of the first ways that we're going to talk about this is tax advantaged accounts, right? We've gone over a lot of these, right? IRAs, 401ks, HSAs, 403bs, right? Because tax advantage accounts, you know, you really should be doing these, right? Because if you're not participating in a tax shelter retirement account, it's, you know, it's smart to do so, right? It's potentially the biggest tax break you're going to get. Not only will investment earnings within the account be tax deferred, but your contributions will generally be deductible from your taxable income, right? If your employer offers a defined contribution plan like a 401k, 403b, or a 457 plan, you should sign up if you haven't already, right? If you have, you should maximize your contributions. The IRS allows you to contribute up to 100% of your earned income, right? Up to 19,500, right? Or 26,000 if you're 50 or older, right? If you don't have an employer-sponsored plan, then just open a traditional IRA. You can contribute and deduct up to 6,000 per year, or 7,000 if you're 50 and older. And if you're self-employed, you should definitely investigate opening a plan specifically for the self-employed, right? That could be a simple IRA, a SEP IRA, a solo 401k. We've talked about these briefly before, right? The simple IRA permits a contribution of up to 13,500 or 16,500 if you're 50 or older. The SEP IRA and solo 401k have more generous contribution limits, right? The maximum is 25% of your net business income, up to 57,000 per year for both plans, and an additional 6,000 on a solo 401k if you're 50 or older. You can open all types of retirement accounts through a full service investment broker. Say, who are we going to use? Let's say E-Trade, right? They offer both traditional and Roth IRAs. And if you're self-employed, you can also accommodate a solo 401k account and simple and SEP IRAs, right? What's more, um, whoever you use might offer, commission-free trading of stocks, options, ETFs, as well as several managed investment accounts in case you don't want to do the job yourself, right? So next thing we can talk about is hold investments for at least a year, right? The tax law makes an important distinction between short-term capital gains and long-term capital gains. Short-term capital gains are taxed at ordinary income tax rates, which can be as high as 37%. But long-term capital gains, right, investments held for more than a year, are generally capped at about 20%. However, most taxpayers will pay a long-term capital gains rate of either 0% or 15%, right? And the reason why this is, the reason why that's the case, you should plan on holding your investments in taxable accounts for a minimum of 1 year before, selling. The tax benefit on large gains is going to be quite big, right? Um, the third thing is going to be sell losses to offset capital gains or reduce your taxable income, right? Um, you know, if you continue on the topic of capital gains, you can sell losing positions to generate losses that can offset gains on winning positions. If you've lost money on an investment, you may as well get a tax benefit from the security. You can deduct capital losses up to the amount of capital gains you have during the tax year. And if those losses exceed your gains, you can write off up to $3,000 against non-investment income. Either outcome will reduce your capital gains income, whether long-term or short-term, and that will lower your tax liability. I know there's a lot of controversy around them, but Robinhood is a good choice for trading securities on a more frequent basis, right? It's an investment app that offers fast, efficient, commission-free trading of stocks and ETFs. It's a natural choice for taxable brokerage accounts, as well as a perfect platform for those year-end capital loss generating security sales. The next thing that we need to talk about is going to be, to hold your interest in dividend bearing investments in a tax sheltered account. Right? Stocks that pay dividends are an important part of most investors' portfolios because they provide reliable income despite stock market up and downs, right? But as with any investment income, dividends are taxed. Here are, a couple ways to optimize your dividend paying investments for taxes, right? Your IRA is the best place for high dividend paying stocks. If you can, hold dividend paying stocks and funds in an IRA and other tax advantage accounts because these accounts grow tax free. You won't pay taxes on dividends that are reinvested every year, right? And you really need to kind of look out for the wrong type of dividends, right? The IRS categorizes dividends into two categories, qualified and non-qualified, right? What you need to know is that qualified dividends receive special tax benefits, whereas non-qualified dividends are taxed at your regular income tax rate. You'll want to take that into account before choosing an investment that pays non-qualified dividends, such as real estate investment trusts, right, or REITs. The next thing is going to be invest in funds with lower turnover, right? Investment funds can be a wellspring of capital gains, which can be a problem in tax time. The best way to avoid this is by investing in funds that have low investment turnover. Turnover is going to refer to the frequency with which stocks within the fund are traded. An actively managed fund may have a trading frequency of 80 or 100%. That means the entire portfolio is traded within the course of a year. A better option, from a tax standpoint, is to go with low turnover funds. The best are generally index funds. They trade stocks infrequently, right? Since the portfolio is tied to an underlying index. In fact, securities are traded only when the composition of the underlying index changes. And since that's so infrequent, they'll generate far less in the way of capital gains than actively managed funds. What's more, the capital gains they generate are more likely to be of the long-term variety, which will result in a lower tax rate on those gains. So another thing to talk about is an HSA. I know we talked about this briefly in a couple other videos and stuff like that, but we got to bring it up again because it's important, right? Because if you qualify based on your health insurance plan, you could open up an HSA, and if you can, that's a major advantage of tax time, right? To qualify for an HSA, you must participate in what's known as a high deductible health plan, right? That's defined as a health insurance plan with a minimal annual deductible of $1,400 or $2,800 for a family plan. The plan must also have a maximum out-of-pocket limit of no more than $6,900 or $13,800 for a family plan. But if you qualify based on your health insurance plan, you can open an HSA account and contribute up to $3,500 per year or $7,100 for a family plan. Your contributions are tax deductible against earned income. Meanwhile, any withdrawals taken for approved out-of-pocket medical costs can be taken tax-free. But any funds you don't spend during the tax year can be, retained in the plan and invested. While banks and credit unions are popular HSA plan sponsors, you can also hold a plan with an investment brokerage where you can invest the money much as you would an IRA. Invest your taxable income, your taxable fixed income portfolio in municipal bonds, right? If you have a taxable investment account and some of that money is invested in fixed income securities, switching some of those positions into municipal bonds or municipal bond funds will be a way to provide tax-free interest income. Not only is this municipal bond interest tax-free for federal income tax purposes, but it's also free from state income tax if the bonds are issued by an agency or municipality located in your state of residence. This is what's known as double tax-free. It can be a serious benefit if you live in high tax states, say New York or California. For example, if you're in the 22% federal income tax bracket and 10% for state income tax purposes, municipal bonds will save you 32%, tax hit on your interest income. If you're going to be earning interest on your portfolio, you may as well make it tax free. One of the last things to talk about is to work with a financial advisor to provide, good tax planning, right? So especially, if you're in one of the higher tax brackets, and especially if you have a significant amount of investment assets, it may be time to work with a financial advisor. In addition to providing investment management, they offer other services, including comprehensive tax planning. Right? If you think hiring a financial advisor is expensive, think again. Just as the internet has revolutionized almost everything in the financial universe, it's also made significant changes in the financial advisor space. We've also talked about this in a previous video. If you guys want to go check that out, it might really be able to help you guys figure out who to talk to, what questions to ask, stuff like that, right? So, we've gone over the 8 things you really ought to be looking for when it comes to trying to help lower your taxes and stuff like that. So hopefully, one of these things might help you guys, save you some money come tax time or put a little extra money in your pocket. That way you can get out of debt faster and invest more, right? I really hope you guys enjoyed this video. If you did, go ahead and give it a thumbs up. Subscribe to the channel if you're not already. And until I see you guys in the next video, y'all be safe.